Okay, we're going to talk about receivables a little bit, especially accounts receivable, but we're going to talk about some of the other receivables that a company might have. Accounts receivable are just the receivables that they use, that companies use to buy things back and forth. It kind of greases the wheels of commerce not to have cash in hand when you buy or receive something. They're usually due within 30 days to 60 days, something like that. Notes receivables are witnessed by some kind of a formal instrument. The formal instrument declares who owes the money, who they owe it to, how much it is, what the interest rate is, when it's payable, how it's payable. For example, maybe they're going to have to be making payments throughout the life of the note, or maybe just payments of interest throughout the life of the note, and then paid off the principal at the end. But it's going to determine, it's going to detail all that in the formal contract. And then other receivables, such as interest receivable on the notes, receivables from officers or employees, taxes. I don't usually have taxes receivable in my businesses, but I'm sure they could be. I imagine the governments show taxes receivable. But anyway, interest receivable, think of a note that straddles the year. The note is issued in one year and then paid off in the next year, assuming that the payer, the borrower, is going to pay all the interest and the principal at the end of the duration of the note, the term of the note. Then at December 31st, we're going to have to make an adjusting entry to debit interest receivable and credit interest revenue or interest income. Then when they pay the note off, we're going to record at that time the interest revenue, debiting interest, crediting interest revenue for the amount from January 1st through the payment of the note. We're going to debit interest. We're going to credit interest receivable that we had in the adjusting entry. We're going to credit that amount in the entry, and then we're going to debit cash. They should be paying the whole thing off, and we'll also credit the note receivable, the principal amount for that. Anyhow, that's how that works. Let's see. Anyhow, every once in a while, no matter how good you are at watching your bad debt expense, about being careful with who you lend money to or lend credit to, you're going to have some bad debt expense. Everybody does it. The more of that you have, the worse it is for you, but that's the way it goes. I love this little list. It's in the book. Some indications that an account may be uncollectible. The receivable is past due. Okay, if it gets over a few days, not so bad. It gets over a week or two, a month, and then I'm starting to get worried about it. By 6 months, I know it's going to be a problem, no doubt. Okay, the customer does not respond to the company's attempts to collect. You send them letters, you call them, you send them emails, you text them, nothing, no response. That's a bad sign. Oh, if the customer files for bankruptcy, I don't know how they got this in here, but yes, that's definitely a red flag. If I see my customer filing for bankruptcy, I'm probably going to be thinking that his account may go bad on me. He closes his business. Again, this is a good flag here. If you find your customer has closed his business, then yes, that's a bad sign. And then you can't locate him. He's moved. He lived in a house trailer, and you go to see him, and the house trailer is gone, and all you can find is a hookup there. Yeah, it's a bad sign. You're probably not going to collect that one without a lot of trouble. But anyhow, we mentioned the direct write-off method, which is for each account you decide is uncollectible, and the time you decide it's uncollectible, you go ahead and debit bad debt expense and credit the account receivable, Joe Blow, whoever that is. This violates the matching principle of accounting, and is not a kosher according to GAAP, generally accepted accounting principles. Small businesses do it this way, but they don't have many receivables. Any business with quite a bit of receivables is going to have to do the uncollectible or doubtful accounts method, the allowance method. That's the only way to do it. Okay, you can estimate the bad debt expense two ways. One, the percent of sales method. If you look here, we have the balance of accounts receivable at $240,000. I don't care about that. the balance in the allowance for doubtful accounts account. I really don't care about that. Credit sales, not all sales, credit sales. If cash sales, they're collected immediately, so we don't have to worry about that. But they have credit sales of $3 million. I'm interested in that. Historically, I've found, or this company has found, that 0.75% of sales, credit sales, turn out to be uncollectible. So if I compute 3/4 or 1% of sales as uncollectible, I come up with $22,500. Now in this case, this is what we call the income statement method. What we're figuring here is the bad debt expense. We're worried about the expense, not the allowance. I have no idea what the allowance the allowance balance is. I don't care what that is. All I worry about is 0.75 or 1% of credit sales, $22,500, and I make an entry like this. I debit bad debt expense for $22,500, and I credit allowance for doubtful accounts for the same amount to record the bad debt expense. All right, the other method is the analysis of receivables method. It's a little more complex, but it's not, it's no great shakes. What you do basically is you take each account that somebody owes you, each account receivable. You figure out the due date. If the due date is past, then they are overdue, and you place each one in a category based on how long overdue they are. And most people have categories called current or not past due. That's for all the people that are the due date hasn't arrived yet. 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due. Once it gets to 90 days, a lot of times you'll go on to either 120 days, go from 90 to 120, or something like that. Then you go over, then maybe go from 120 to 180, pardon me, and then maybe even a year, 300, say call it 360 or 365. We usually use 360 in our minds for these calculations. Anyhow, each category, you can imagine that the current category is going to have a percentage a percentage that historically has been uncollectible. For example, like say the current amount, the current class, maybe 0.5%. The 1 to 30 days past due, a little higher. This 31 to 60 days, quite a bit higher. Then by the time you get to 90 days and 180 days past due, that's 6 months old. It'd be difficult to collect that. But you're going to multiply the total of each class by that percentage, and then total those amounts that you come up with, and whatever that figure is, you're going to adjust the allowance account to reflect that figure. In this case, I'm not worried about the expense. I'm concerned with the balance in the allowance for doubtful accounts account, and we do it this way. This is from the book. It's copyrighted, so just letting you know that Cengage has that copyrighted. But here is a partial list. I say it's partial. It's a spreadsheet with all the customers listed down the side. But you notice there's a break here, and that wavy line means that there's some data missing. We've skipped a few lines. They're recorded in these totals right here, but we're not showing the individual amounts here. Anyway, we ended up with $125,000 not past due, and historically 2% of those are uncollectible. 64,000 in the 1 to 30 day past dues, 5% uncollectible. Multiply 64,000 by 5%. There you go. There's the total there. Even though this is almost half of this, the uncollectible amount is more. In this case, there's just a little bit, 31 to 60 past due, but 10% uncollectible. Then by the time you get to 365 days past due, we're saying that's 80% uncollectible. $14,000 and $11,200 of it is not collectible. So at some point, we're going to start writing some of these off. Anyhow, we total all these numbers up to get the total here. And that is the amount. This is what we want the balance to be in the allowance for doubtful accounts account. Now, we know that the balance in the allowance for doubtful accounts account was $3,250 credit. We want a credit of $26,490. So I need to get the difference between those. This is a credit balance already. I need to get to this number as a credit balance. So I'm going to have about $23,000 and change to get there. As I mentioned in class, the balance in the allowance account could be a debit, and it gets hopefully pretty close to the line, but it could be a credit of $3,000, and a debit of $3,000, in which case we would have to get $26,490 as a credit from a debit of say $3,250. Then I'm going to have to put in about $29,000 to $30,000, whatever that number is, to get there. So that leaves us with a current balance in the allowance for doubtful accounts before the adjustment of $3,250 credit. We want a balance of $26,490 credit, so the needed adjustment is going to be a credit of $23,240. I'm going to make the entry like this: debit bad debt expense for $23,240, and credit the allowance for doubtful accounts account for $23,240. And in this case, I'm not worried about the expense. I don't care about the expense. I'm not worried what this number is. I'm just trying to get the allowance for doubtful accounts to be $26,490 based on my analysis over here.